In this video, you're going to learn about some of the most common interview questions on the topics of equity value, enterprise value, and valuation multiples. And some of this is going to be a summary from all the previous videos in this course, but I think it's good to just review everything we've done up to this point so that you can be better prepared when we move into the valuation section of the course right after this. So probably the most basic question you can get on equity value and enterprise value is just what is equity value, what is enterprise value, how do you calculate them? Equity value, as we saw before, is just the share price times the number of shares outstanding, or diluted shares outstanding if you're looking at diluted equity value. Whereas enterprise value takes equity value, subtracts cash, adds debt, minority interest, preferred stock, and then possibly other liabilities like pension obligations and so on and so forth, capital leases. The difference between them is that equity value is sort of like when you go to buy a house and you look at the list price of the house, that's just what it seems to be worth at first glance, whereas enterprise value reflects the true cost to actually acquire a company. Because cash is sort of like a free gift. You get the company's balance sheet when you acquire it, so you don't have to pay anything for the cash, and it effectively lowers your purchase price, whereas the other items here, effectively, you're going to have to be paying for in some way, shape, or form. So you might have to repay the debt, you might have to repay their pension obligations, and so they're going to add to the true cost to acquire this company. Now, if you get asked about why you add or subtract individual line items to go from equity value to enterprise value, for cash and investments, it's pretty simple, just what I said before, that these are either cash that reduce the effective purchase price or investments that you could sell to get cash. Debt is added back because usually you have to repay it or refinance the debt when you acquire a company. Minority interest, this one the reasoning is a bit different. This one you add because when you own over 50% of a company, that company's financials would show up on our income statement. So if Apple owned over 50% of a company, their revenue and profit would show up on the income statement right here. So to reflect that, we need to add in the portion of the company that we do not own. So in the minority interest here, if we own 60% of a company, then for the minority interest, we need to add in the value of the 40% that we do not own. And that's why we add that in, to do an apples to apples comparison. Because if we're showing a company's financials in ours, then we want to also be showing the company's value in our enterprise value. So we want to do an apples to apples comparison. That's why we add in minority interest here. Preferred stock you add because it's more of a debt-like item. Preferred stock investors get a guaranteed dividend, some type of interest rate on the amount of preferred stock outstanding. They also have a higher claim to a company's assets than equity investors. And then other liabilities like pension obligations, restructuring obligations, capital leases. Again, these are added back because they're more like debt in the case of capital leases with interest expense, for example. Or in the case of pension obligations and other liabilities like that, often these are huge items that are unfunded, and if they're unfunded, then someone is going to have to pay them eventually, which, if you buy the company, is going to have to be you, the acquirer. One other question you could get on this topic, and this is something we only touched on briefly, is just should you use the book value or the market value for all these items? So the book value is referring to what's listed on the company's balance sheet and in their filings. So the book value of debt might be 500 million, but then on the market, it's only worth 400 million. Which value do you use? Well, the answer here is that if you can, you should use the market value, but it's not always possible. Sometimes it's very difficult to find that information, especially for items like minority interest and preferred stock. Oftentimes it's close to impossible to find this information. So if you can get the market value of all these items easily, then you should use that. If not, just go with the book value. So it's always preferable to use the market value, but oftentimes in investment banking, you just don't have the information, you cannot access it, and no one really knows what the fair market value is. So you often just end up using the company's book value and pulling the information from filings anyway. Another question you can get here is how do you calculate diluted shares outstanding? And what you do is you take basic shares outstanding and then you add in dilution from options, convertibles, and other securities. How do you do that? You use the treasury stock formula. Just to review this, for the treasury stock formula, basically what you do is you take the number of options and then the exercise price. And the way dilution works here is that if the exercise price is above the share price, then you get zero dilution because these options are not exercisable. Otherwise, you take the number of options and then you subtract options times the exercise price. That's how much money the company gets, and then you divide by the current share price. Because what you're really doing here is you're assuming you're paying the company, and then they're taking that money and they're using it to repurchase their shares on the open market. So that's how you calculate dilution and how you use the treasury stock method. If you can, try to use that formula in interviews. If not, then just do the math yourself in your head and think about it like I just walked you through. Think about how many shares get created, and then think about how much you're paying the company, and then how many of their own shares they're going to repurchase with the funds that they're getting. If you're asked about how you take into account convertibles, it's actually even easier, because for convertibles, you don't have to even do the treasury stock method. You just take the number of new shares that could potentially be created, and then if they're actually convertible, if the share price exceeds the conversion price, then you assume that they're all changed into shares. If they're not convertible, then you count the convertible debt as debt instead. If they are convertible, you just add it to the share count and you do not count it as debt. Another interview question is, could you ever have a negative equity value or a negative enterprise value? So the answer for negative equity value is no. It's impossible to have a negative equity value because the shares outstanding right here always has to be 0 or positive, and then the share price also has to be always 0 or positive. So there's no possible way you could have a negative equity value, a negative market cap. Enterprise value, however, could easily be negative. Just to show you an example of this, let's say hypothetically we had 200 billion worth of cash. And there you see it. We have a negative enterprise value right there. So enterprise value could easily be negative because we're subtracting cash to get to this. If we have a huge cash balance, enterprise value can easily turn negative. What does that actually mean? Well, usually an enterprise value is negative when you're either dealing with a financial institution that has a huge cash balance, or when you have a company that is very troubled financially. Sometimes a negative enterprise value can be an indication that you're going to get a good deal when you buy that company, if it's financially troubled, for example. For a financial institution, enterprise value is sort of a meaningless metric, and you almost always just look at equity value. So in the case of a financial institution with a huge cash balance, if you have a negative enterprise value, it doesn't really mean anything. It just means you should be looking at equity value instead. On that note, you may also get asked about the difference between equity value over here and then shareholders' equity on the balance sheet. And I've seen that there's a lot of confusion between these two items. Here's the difference. Shareholders' equity is a book value. It's the value of the company according to only what's on its balance sheet. Whereas equity value up here, market cap, is the company's value according to the market. So one is a book value, one is a market value. Equity value or market cap can never be negative. It always has to be 0 or positive. Whereas shareholders' equity over on the balance sheet, this one is usually positive, but it can actually turn negative. For example, if you have a negative retained earnings balance right here and it's very large, the company has been losing money over a number of years, or they've been paying out dividends that are too high, you could easily have a negative shareholders' equity balance. It's certainly not a positive sign, but it's also not necessarily the end of the world. It depends on the situation and why you actually have a negative shareholders' equity in the first place. Another question on this topic is why you use different valuation multiples and different valuation metrics. And we went through a number of examples for this. We looked at EV over revenue, EBIT, EBITDA, free cash flow, PE, price to book value. I'm not going to repeat all that here because it's covered extensively in those videos, but essentially, when you're looking at revenue, you're focused on the company's top line sales. It's more applicable to companies like internet startups, any company that has revenue but not much in the way of profit. EBIT and EBITDA, you're focused more on profitability. EBIT is more appropriate for capex intensive or depreciation intensive industries where it's actually important. EBITDA you use in industries like internet, healthcare, for example, where there may be some depreciation, but it's not as important as it is for asset intensive industries. Anything in services, for example, would also use EBITDA. Free cash flow you use when capex is important and you want to take it into account, or when you have large changes in working capital or deferred revenue, for example. PE and price to book value, these are most applicable for financial institutions and banks that are very focused on how much interest income they're earning and where capital structure is very important. So use these most often for those companies, financial institutions. You can look at PE for other types of companies as well, but it's certainly most common for those. Examples of other multiples would be EV over EBITDA, which you use for retail companies, airline companies, for example, where rental expense is very high. For technology, a couple examples would be EV over unique visitors or EV over page views. These are both for internet companies. These are important metrics for them. When you go into real estate, you look at metrics like funds from operations or FFO, and then adjusted funds from operations. The reason you look at those is because with those metrics, you're adding back depreciation, which is a huge expense, and then you're also taking out gains on the sale of properties. So you're coming up with a more normalized metric of how much the company's actually earning. You often divide these by the company's share count. So you look at these in the same way that you look at PE on a per share basis. And then for energy companies, you have metrics like price over millions of cubic foot equivalents, and you're focused really on their energy production, their reserves, how much energy they can actually produce. So those are a few examples of different multiples and metrics for different industries. Now, if you get asked about whether you should use enterprise value or equity value with a given multiple, the easiest way to decide on that is to look at the metric you're given, figure out whether it's before interest, income, and expense are factored in or whether it's after they've been factored in. Revenue, EBIT, EBITDA, those are all before interest, income, and expense hit your financials. So you use enterprise value for those. But free cash flow, levered free cash flow, earnings per share, and book value, these in effect all either have interest, income, and expense already factored in, or in the case of book value, you're excluding liabilities like debt, preferred stock, and minority interest. And so that's why you look at the share price or the equity value for price over book value. The same logic applies if you get anything else more unusual. So if you get a metric like unique visitors, for example, well, unique visitors directly lead to revenue, and revenue we know that you use enterprise value with. So you have to sort of think about it and reason your way through it, but that's how you should think about it. If it's before interest, income, and expense, use enterprise value. If it's after, then you use equity value or share price. One final somewhat tricky question here is, why is it that if you take price divided by earnings per share, why is it that that could be different from equity value divided by net income? And the answer there is that the share counts could be different. We saw here, for example, that our PE ratio for PE multiple for 2007 was 48.9x. But if we take our equity value and we divide by our 2007 net income, well, we get to 50.59 or 50.6x. The reason that happens is because we have different share counts. Up here, we're using 920 million for our diluted shares outstanding, but for 2007, we're using 889 million. So the different share counts can explain that. So normally they're fairly close, but hardly ever are they exactly the same. Usually there's at least a small difference because the share counts that you're using are often different. So that's an overview of some of the most common interview questions you can get on these topics of equity value, enterprise value, and valuation multiples in investment banking interviews. I know I went over this very quickly because it was a review of everything that we've done before. If you want more help or practice with any of these, look at some of the previous videos in this course, or you can also review the handouts which go into some more detail and give you all the formulas. But really, if you understand everything that I went over and understand intuitively these questions and how these concepts work, then you should be in good shape for interviews. Coming up next, we're going to be getting into the valuation of Apple. And so we'll be looking at how we use comparable companies, comparable transactions, and then a discounted cash flow analysis to take all the work that we've done here with looking at their financials and their multiples and actually use them to assign a value to Apple.